everyone, welcome. My name is Agostino with Bulletproof Cash Flow. Today we're going to talk about the 8 ways to reduce your risk on a multifamily investment. Okay, so I'm super thrilled you can join me today. Greatly appreciate it. We always love delivering this type of material to help you guys succeed in the world of real estate. All right, so I'm going to talk about some very crucial strategies for mitigating risk in your multifamily real estate deals. Okay, so either you're an investor yourself, maybe you're participating in an investment, maybe you're already in an investment now and you want to try to reduce risk where you're at right now just because of where we are in the economy. Any one of these types of scenarios will fit this webinar right here. Okay, so it really is helping you tee up your deals for success no matter what the market condition is. All right, so like I said, if you don't know me, my name is Agostino with Bulletproof Cash Flow, and we help people get into the real estate game. Okay, there's 3 primary things that I focus on. The first is multifamily, right? I basically acquire B and C type of assets, primarily workforce housing is what it's called. We're looking for a value add type component. We get in there, we fix them up, we make them better, and we make the community very vibrant to keep people happy living there. Okay, that's our primary goal there. Secondly is development. So we do either ground up or adaptive reuse. What that means is we're either buying the land, getting the plans, lining it all up and building it, or we're looking for offices or some sort of conversion play where we're converting maybe a high rise to multifamily. Okay, a lot of office out there right now. I think that given what happened back in 2020, a lot of people started working from home. This made a whole lot of vacant offices now available. So a lot of people need a place to live, right? We still have a housing shortage right now, believe it or not. It's still taking place, right? Those people need homes. We're building them, okay? And primarily though, what we're doing is something called urban infill. So we're looking for areas with a lot of traffic and a lot of money. There's a torrent of financial transactions taking place. That's where we're looking to go, all right? The third is we have a fund. We have a blind pool fund that acquires Dollar Generals, Dollar Trees, Walgreens, retail locations, right? Corporate-backed assets is what we're looking to do, right? So like I mentioned, Dollar General, Dollar Tree, Walgreens, CVS, Advanced Auto Parts, VCA, Animal Hospital, all these types of companies have a corporate guarantee on the real estate for the tenant that's there, right? So we're looking for those types of deals, all right? So we've transacted all in all at about $350 million of these types of assets. So I know something about putting these deals together, right? So what I'm giving you today right now is based on real life experience, okay? Tried and true methods is what I'm delivering to you, right? Also, check out our YouTube channel, okay? On the YouTube channel, God, 700 videos there already, plus we have our webinar that's on there. All the webinars are there, past webinars are there. We also have our show, the Bulletproof Cash Flow show that's there too. Okay, so if you're watching this replay, do me a favor, like and subscribe. It helps the algorithm. It helps us reach more people and get out there, and it adds this to our success as well. So I'd greatly appreciate it if you get the value out of this. Would greatly appreciate it. All right, so let's get into it. All right, I started in real estate back when I was still working in corporate because I was looking for cash flow, I was looking for appreciation, and I was looking for the tax benefits. And you can get all those things if you do it right, okay? But without the proper planning, you can make some big, significant financial losses and also a whole lot of headaches too, okay? You don't want to deal with that. So my goal today is to ensure that you have the tools to invest wisely, all right? So let's go ahead and get it rolling here. So let's talk about the first point, all right? Point 1. Oversight and transparency, okay? This part is absolutely critical to reducing risk. You have to basically have consistent oversight and a great deal of transparency, okay? So let's say you acquire a property, okay? And your asset management approach is absolutely crucial, all right? And let me delineate here. I'm gonna take a step back for a second. You have property management. These are the people that actually run the property itself. But here's the thing. You are an asset manager, or someone on your team has got to run the assets. You're basically running the property management company. Okay, so there's you and maybe you're running, maybe you have 5 or 6 or even 10 of these different properties. If you're the asset manager, you're the one making the overall decisions to monitor the performance of the property manager. Okay, if they're not doing their job, you have to do something about it, right? So that's what an asset manager does. Okay, so that's the context I want to introduce you to. So it's not as simple as just buying the asset, set it, forget it. There's actual work involved in terms of running the property manager. Okay, so what you have to do is, the first thing when you're in this point is review the financial statements in every detail. Okay, sit down at least once a month with the property manager, verify that proper categorizations are taking place of your income and expenses. Okay, meaning I've seen this numerous times where they're taking operating expenses and mixing it up with capital expenses and vice versa, right? All the time, right? And your operating is, just as the word implies, is operating of the asset itself. Okay, maybe you're paying electric bill for a common area, or you're paying for snow plowing or lawn care or whatever. You're operating the asset. Capital expenses are, maybe you're going in and you are changing up all the flooring, okay? Or you are improving the property. You're putting money into the deal to improve it. That's a CapEx expense. I often see, when I'm reviewing the financials, a mix-up of the two, okay? As an asset manager, you have to make sure that the property management company is properly categorizing these things, because if they do it wrong, it's going to have an overall impact on the valuation of the asset. Okay, so this is a part you got to be relentless about understanding your numbers, really, because what it comes down to. Okay, the second part of this point is secret shop your buildings. Okay, this part is interesting. If you're able to go into the property unannounced and start looking for issues before you go into the leasing office, if you have a leasing office, okay? Secret shop it. Pretend, take off your asset manager or owner hat and start walking around the property as if you're going to rent the place. And then ask yourself, would I feel good about renting in a place like this? If the answer is no, then you know what? You're going to have a problem, okay? While you're there, start walking the units. If they don't know who you are, walk the units. Walk them. Go into the kitchen. Make sure everything is running properly. Taste the tap water. Make sure the water works. Flush the toilets. Make sure the toilets work. Look for any leaks. Look underneath. Check the dryer vents. Is everything clean? You're looking for everything. Look at outside the grounds. If there are any weeds growing or whatever the case may be. If you start seeing all that stuff, okay, the property management company is not doing their freaking job. That's what it is. And again, when that happens, you're the one that has to make the changes if necessary, or at least have a talk with them and see if they improve. Okay, you put them what's called a PIP, a property improvement plan. Okay, you sit down, you discuss it, and give them a plan and a timeline. If they don't hit those certain goals, then you know that you're gonna have to start making plans to eliminate them. Okay, when you're talking about your money and the money of all your investors in a deal, okay, you have a fiduciary responsibility to all these folks that believed in you. So you have to be ruthless and relentless when it comes to your money, okay, and the money that they put into the deal. The third point of this is that you have to share everything with your investment partners, okay? Consistent communication is absolutely key. It's probably one of the biggest things that many syndicators fall flat on. They don't communicate. And when you don't communicate with your investors, they feel like, that they might have just put their money into a black hole and it's gone now, right? You have to be transparent with your investors. Usually, well, not usually, what we do when we close the deal, we're communicating on a monthly basis for probably about 6 months, and then we change to a quarterly. And then we send out quarterly reports, okay? We talk about the CapEx, talk about it in detail. We even do video calls. We do video walkthroughs as well. We stay very, very visible. A lot of the videos that we put up on YouTube, it's mostly just me interviewing folks, but they see that I'm still active. I'm still in the game. And they know that even though I might not be talking about their deal, I'm still visible. I'm still putting myself out there, okay? When you do these types of things, it fosters an open dialogue, and helps build trust with them, okay? But this overall oversight of these 3 points, okay, will give you the transparency that you need to catch problems early with your investor, not with your investors, but with your properties and your property management team. Catch them early before they escalate into big problems, okay? Now, point number 2, realistic underwriting. This is something that I see a lot. You have to be conservative when you're underwriting your deals, okay? I remember years ago when we were running our in-person events, I'd have guys that bring their laptops, and they were suggesting a 5% rent increase annually from now and forever. When there's an economic downturn like there is right now, and people have choices of where they're going to live, you cannot predict a 5% increase. Now, typically 3% is the norm, but if you want to stay conservative, I ratcheted it down to 2%. And I also ratcheted up the expenses too. They largely kept the expenses. Some of the newbies, they keep it flat. You don't want to do that, okay? You want to be conservative with your numbers, okay? You don't want to be super aggressive. Even if you think that might be, you know what? Do your best to make them as conservative as possible, okay? You want a best case scenario. Maybe you underwrite based on a 70 to 75% occupancy, not 95% plus, okay? Don't do that. Based on 75, 70%. How does it perform? Does it perform well? I mean, if it does, then great. Then you got a winner. But if that thing has to be at 90 all the time, and it goes all the way down to 70, and you're staying there, you're gonna have a hard time, okay? Thing is, though, it goes back to that first point I was mentioning about running your property management company. If the property management company decides not to do their job, that's where you switch them out, right? But you have to plan for such things too, right? But, listen, here's the thing. If you're able to keep it at 90%, great. You want to be pleasantly surprised that you're able to outperform than be inaccurate and having to explain to your investors what's going on. You don't want to do that, okay? Analyze the deal as if you're going to run at a much lower occupancy, so that way you'll know if your vacancies start rising, you might have to bleed some cash out or whatever. You're going to want to know what's going on and also how you're going to fix it, right? Otherwise, again, like I said before, you want to make sure that the asset is able to sustain a worst case scenario, okay? You want to be able to, they're able to sustain a worst case scenario. And if that's the case, then what sort of reserves would you need to have just in case, so you can rescue it, okay? But conservative underwriting ultimately gives you the room for error and a margin of safety is what it does. Point number 3, financing and reserves. Okay, so this is the first critical way to reduce risk is to secure the proper long-term financing on a deal. Again, depending on the type of deal you're buying, right? If you're looking to get a nice stabilized type of asset and you can get decent rates these days, you lock it in for as long as you possibly can, okay? I've had deals where I bought it at 90% occupancy. I locked that up at like a 3.2% interest rate for 7 years, right? The intent was to hang on to it at a low rate for a long period of time, okay? Generally speaking, when you're financing multifamily, you have 3 options. Number 1, seller financing. This is the most flexible option. You can customize the terms any which way you wish. I've done it on numerous deals, and in economic times like we're experiencing today, many people may actually be interested in doing some seller financing, right? Why? Because the seller gets to participate, so to speak, in the upside of actual financing the deal. Depends on what the seller's actually doing with the money afterwards, right? But if they're just looking to help offset a bunch of taxes, that might be the best way to go. Secondly, a bank loan, right? It's another traditional way of doing it. You're looking at a 5 to 7 year type deal. Sometimes it requires a personal guarantee, sometimes it doesn't. Depends on the asset, depends on the deal, okay? Third, which is very popular these days, is agency financing. And you're talking about like a Fannie, Freddie, a fixed rate type of deal. maybe even FHA or even a USDA. Most people don't know that you can get USDA financing on certain farmlands and other farm-related type of deals, right? So it'd be very similar to the look and feel of a Fannie Freddie type of loan. The thing to realize, though, it's a long period of time to get that loan closed, right? That's the thing about Fannie and Freddie, or even FHA for that matter, right? So you have to have all the documents. You have to be Johnny on the spot with everything, very, very quick to get the information to them, okay? So if you don't have Fannie Freddie already under your belt, you can partner up with somebody else that does and get you into the club. So once you get your first Fannie Freddie deal, you can then go off and do it yourself afterwards, right? Generally speaking, that's the rule, right? So in that case, you can find someone who's done Fannie or Freddie before. I have, for instance. And that's how I did it. I partnered up with someone else. They actually had Fannie Freddie experience. We did a refi and a deal. Now I can go get Fannie and Freddie without them. I can do it on my own, right? Long time ago. That's how I got into it. That's how you can get into it too, by partnering up with somebody, right? But if anything, these days, try avoiding the short-term floating bridge loans if possible, okay? I know they're enticing because they're going to close very, very quickly and get the high leverage, but at the end of the day, they're going to leave you extremely exposed to high interest rate hikes. I think there's still going to be a couple of hikes, after the time of this webinar here. There's probably going to be at least 2 more hikes by the end of the year. That's what they're anticipating. Whether or not it's true, we don't know, but that's what I'm hearing. So, you know what? This is the type of thing where you don't want to take risks on doing such things. At the same time, there are something called a rate cap, tremendously expensive, especially today. I mean, it's an option. I don't like it, right? I think it could be very expensive. Instead, you know what? Lock in a low fixed rate for 5 to 10 years, even if that means maybe you have to get lower leverage. That means you have to raise more capital, is what it means, right? But you have to ensure that your debt service payments remain predictable despite the market volatility. That's what you're looking for, is that predictability. In economic times that we're in right now, people want predictability. That's what they want, okay? Also, overfund your operating reserves, okay? Do that right from the beginning. Have at least 6 months of expenses socked away just in case, okay? And because something might come up. Maybe you're going to have some sort of management fee of some sort that you weren't anticipating. Maybe insurance. Listen, insurance companies are going crazy right now. They're dropping actual buildings, like in terms of as customers. Then they're having to come back in and redo the whole deal again. Taxes are not going down, guys. They're not. They're going to keep going up. Okay. Utilities are going up as well. Maybe you want to consider, if you haven't already, doing some sort of RUBS, race utility billing system, or doing some sort of sub-metering of both water and power, right? Maybe something to do there. You might have some maintenance costs you weren't anticipating. You may have to do a big marketing push to help bring up your occupancy. Who knows? But the point is that you want to have ample reserves so you can weather a predictable long-term downturn in occupancy without being worried about it, okay? Never let a temporary disruption really force you into a low price or distressed sale when you're not ready for it. That's what you're trying to offset, is that, okay? Point number 4, vendors and markets. Now, these two next risk reducers, they deal with both vendors and market selection. And when it comes to vendors, okay, partner up with someone that you know, that you like them, you trust them, and they can work with you on a repeated basis, okay? Try to step away from constantly switching up property managers. Every time you switch, something happens. You're always losing some sort of cost. There's a cost whenever you're switching of anything, okay? Same thing goes with contractors. You want to try to keep the same contractors working on the property. As they get to know the property, they get to know what the expectations are. Again, don't keep the bad performers. I'm not saying that. If you have someone that's not performing, get rid of them, right? For sure. But, if whoever it is, if they're doing a good job, work as hard as you can to make sure that all these folks are paid. Your landscapers, your snow removal guys, all these sorts of folks. Make sure you stay on top of paying the bills on time, because these are the folks that are going to get you through the hard times too. Okay? They're the ones that are going to make the property great. And of course, it translates into good customer service for the people living there. Okay? Ultimately, building those relationships will lead to better service, leads to better communication with these folks as well, and better overall performance. Your partners will have more motivation to keep delivering excellent work as well. What I mean by your partners, I mean the people actually working there. They're your partners now. They're helping you succeed by making the property better. Okay? Now, with regard to market, focus on investing in just one or two submarkets. Okay? Here's the thing. There's so many people, not so much anymore these days, but I remember years ago, I talked to guys in North Carolina that wanted to start investing in Texas because everybody else is going there. You got to resist the urge to diversify into too many states that you're not invested in. Here's the thing. Look, I chose this market. I'm in Cleveland, Ohio right now. And I chose this market to expand and grow in. That's what I did. Okay? We have a lot of units here. If I have 1,000 units and you have 10, and we both have the same property management company, and you call them and I call them at about the same time, whose phone call are they going to answer, yours or mine? Right? The thing is, though, is like that's why you want to stay in one market, focus on that market, know everything about that market. Okay? Because ultimately, what you want to do is really know that market. You want to know what is going on in that market. What are the pluses? What are the minuses? Right down to the neighborhood level. Okay, that's how much you want to know about the property and the market. Okay, it becomes very, very hard to try to manage assets if you're spread too thin in many, many, many different places. Okay. If you don't think if your market is not good for at least 500 units, maybe you need to go to a different market. And you should. You should do that, But it all depends on what your personal goals are, by the way. If your goal is just to have a handful of units, and then fine. You could probably do it great in your market if you live in a tertiary market or whatever the case may be. But it all depends what you're looking for, right? Ultimately, you got to become an expert in your geographic area. Okay, you'll notice the nuances and patterns of certain areas if you start studying different markets, which you should always learn different markets anyway, So you get a feel for what are the differences, what are the good areas, what are the A-class areas, what are the D-class areas, what makes them like that. It's the nuances where the money is made, guys. The nuances is where the money is made. Because this allows you to find the right folks to work in those markets, and it allows you to build a bigger name for yourself with all the brokers and all the lenders and everything else like that's happening in that market. Because it's a good thing when you know the market. It's better when the market knows you. Okay? That's what it comes down to. All right? Point number 5, review the financials. Here's something that is extremely, extremely important. Okay? When you're reviewing your financials, you're trying to use your original underwriting as a guide for your property manager, because this is what you sold to your investors. And it's up to the property management company to keep you on track. Okay? Here's what I mean. Whenever we look at a deal, I prepare my financials, I have the property management company also go and give me a pro forma to see what they think about it. I don't give them my numbers. I look to see what they have and look to see what I have, and I compare the two. And once I compare the two, then I tweak my numbers, and now I come up with the budget. I hand it back over to the property management company. I say, can you meet this budget? And their answer has to be yes. Otherwise, I don't do the deal. Because if they don't think that the numbers are realistic, the deal can't be done. Because ultimately, that is what you're selling to your investors. That's the proper way of doing this business, guys. That's the proper way. Okay? And again, what you're doing now is that as you're managing through the income and the expenses, you're looking at the original, your original underwriting. That becomes the gospel, so to speak. Okay? That is what's sold to the investors. That's what's sold to the investors. So what you're looking for is making sure that those numbers are still intact. Okay, that's what you're looking to do. Number 6, fast track your renovations. Okay, here's the thing. When you set up to close a deal, okay, you get the deal done, you defined what you're going to do, how you're going to improve the property, everything else like that, you do all that work. Now you want to implement the renovation strategy as fast as possible. As fast as possible. Okay? If you have to take a temporary hit to occupancy, then fine, you have to do it. Okay, then that's what's necessary. But avoid dragging out the renovation timeline for years. Why? The renovation, more than likely, when you set up your plan, the renovation's tied to your occupancy. It's also tied to your NOI, your net operating income from rent. And if you're not able to hit those targets because the asset's not renovated, you're gonna have a problem, right? What's more, when you go out and you go get the proposals from all these contractors to do all these renovations, and you don't turn it over, say in, I don't know, 45, 60 days, what happens then? Those quotes go stale. Those quotes go stale is what happens. Okay? What happens then? Well, now you got to re-quote the whole thing all over again. And in today's labor market, today's labor environment, it's hard to hold any type of pricing for a longer period of time. Okay? So the faster you can execute your initial upgrades on an asset, the faster you can stabilize it and reduce your overall risk. So, and like I said, conceivably, if you improve the property for the people living there, you're increasing the rents, you're driving overall asset value is what you're doing, okay? Set you up for a refi, pull out that equity, deliver at least 60% of the money back to the investors and keep on cash flowing the asset. That's the general plan when you're putting these deals together. All right. Point number 7, use consistent vendors. Okay. Like I said before, when I was talking to contractors and landscapers, you want to keep these guys, you want to keep them happy and keep them engaged. Okay. Same thing goes for your lenders too, right? When you're building the relationship with your lenders, you want them to be invested in your success. And if they're doing a good job by you, keep doing it. And number 8, due diligence. Okay. Last, but certainly not least, whenever you are looking at deals, underwriting your deals, I mentioned underwriting on the financial aspect, right? But a big part of your due diligence also comes in performing a complete physical due diligence. So you understand what those renovations look like. You understand what are the targets that you need to hit from a financial perspective, right? You understand everything that's going on in the property. You want to get a good feel for what is happening at the asset, okay? A lot of people fall short when it comes to due diligence. There's actually companies out there that you can pay, they'll just perform due diligence for you, okay? Listen, I don't like doing that. That's just my personal opinion. I don't like it, right? If I'm going to be taking my investors' money and putting it into a deal, okay, I want to walk the property. I want to see it with my own eyes. I want to go touch it, feel it, smell it. I want to know all I can about it. That's just me, okay? I cannot offload that responsibility to someone else. Even if it's my own staff, I'm not going to do it. They will come along with me, absolutely, but I need to see it. I have to see it, okay? This goes into, if you're going to be a fiduciary and manage other people's money, because when you have a syndication, that's exactly what you are doing. You are managing other people's money. They're counting on you to make a good decision. They're counting on you to look at the asset and walk the asset, understand what you're getting them into. You have to at least walk it. You have to. Go sit in to the management office. Go talk to these folks. See what they're saying. Go talk to the tenants if you have to. See what they're saying. What are the problems there? Look on on Yelp and Google reviews. What are people complaining about? Now, take that with a grain of salt, of course, right? A lot of complainer people out there, right? But it's okay. You know what? Here's the thing. What you're looking for is you're looking for opportunity to not only improve the property, but also you're looking for opportunities to make money for your investors. That's ultimately what you're looking to do, okay? So that's absolutely huge. Don't ever skip that, okay? So by implementing these best practices, it'll help set you up and your portfolio up for stability, okay? That is ultimately what you are looking to do here. That's ultimately what you're looking to do, all right? When investors invest in multifamily deals, they're looking for someone to put their money into a nice, stable real estate asset. Performing due diligence around the asset, around the taxes, around any potential thing that can go wrong. It's on you. So make sure you can do that, all right? Listen, if you want to know more about raising money, I know we talked a little bit about raising money here. If you go to guide2capital.com, there's a free ebook. Go ahead and download it. It's totally free, okay? And I talk about how you raise money, right? How do you get into this thing? How do you get started at it? You know, it's a great ebook. I think it's fairly complete, you know? Go ahead and check it out, okay? You won't be disappointed with that, all right? So, like always, if there's any questions, you have any comments, any concerns, you want me to cover something specific, okay? Go ahead and drop it in the chat, or if you're watching the recording, go ahead and drop it in the comments, okay? This will be posted on YouTube probably within the next 24, 48 hours. It'll be on YouTube. Go ahead and drop it in the comments if there's something specific that you're looking for, okay? I'm happy to talk about it. Super happy to talk about it, okay? Thanks for tuning in, guys. Hope you got a lot out of this, all right? Take care. I will see you next time.